Greetings everyone and welcome back to the lesson. The subject is fixed income investment analysis. We are back at it again to solve the questions that were tested in August 2023. We are committed to ensuring that all the past paper questions that are examined by KASNEB for the CIFA advanced level are done. We are moving on sitting by sitting. Today we answer question number 1 from the August 2023 paper. Question 1 is in 3 parts, A, B, and C. Part A reads, in relation to currency denomination, explain the following types of bonds. 1. Dual currency bonds, 2 marks. 2. Currency option bonds, 2 marks. That is the question. In relation to currency denomination, explain dual currency bonds. Dual currency candidates are bonds which are also known as multi-currency bonds or currency option bonds. These bonds are bonds that are bonds where the coupon payments and or the repayment, principal repayments, are denominated in one currency but are paid in another currency at a predetermined exchange rate. Do you understand? Dual currency bonds are bonds where the coupon payment and the principal repayment are denominated in one currency, but the payments are done in another currency. And in a dual currency bond, investors receive payments and the principal amount in a currency other than the one which the bond was issued. Do you understand? The exchange rate at which the payments are converted is predetermined in advance. It's determined in advance, or it's predetermined. The exchange rate is predetermined. And the two currencies that are involved in a dual currency bond are typically chosen based on the issuers and the investors' preferences. You understand? For example, a Kenyan company might issue a dual currency bond denominated in Kenya shillings, but offering coupon payments and the principal repayments in Uganda shillings or US dollars at a fixed exchange rate. And that allows the issuer to assess the foreign currency market while still paying back investors in their preferred currency. That is a dual currency bond. Then the currency options bond, on the other hand, currency options bonds are bonds that give the bondholder the right but not the obligation to convert the bond's principal or interest payments from one currency to another. And that is done at a predetermined exchange rate on a specific date or within specified period of time. You understand? That is a currency options bonds. Bonds, I repeat, that give the bondholder the right but not the obligation to convert the bond's principal and the interest payments from one currency to another at a predetermined exchange rate on a specific date. Do you understand? And the bondholder can choose whether or not to exercise the currency option based on prevailing exchange rates and based on market conditions. So those are the bonds, types of bonds in relation to currency denomination, the dual currency bond, and the currency options bond. I've explained the dual currency bonds. I've said that these are bonds that are where coupon payments and principal are denominated in one currency but are paid in another. Say that they are issued in one currency but paid in another. The coupon payments and principal. Coupon payments, this is the interest. Coupon payment is the interest on the bond. Coupon payments and principal are issued in one currency but paid in another currency at a predetermined exchange rate. That is dual currency bond. Number 2, we have the currency options bond. Currency options bonds. I've said that these are bonds that give the bondholder the right but not the obligation. These bonds give the holder the right but not the obligation to do what? To convert the bond's principal, but not the obligation to convert the bonds principal and interest payment from one currency to another. The bonds principal and interest from one currency to another. The bondholder has the right but not the obligation. It's not obligated to convert the bond principal or interest from one currency to another. That's the meaning of the dual currency bonds and the currency options bonds. Then part B, describe 3 factors that might affect floater's price. Factors that might affect floater's price. Now, floaters are also known as floating rate bonds. These are floating rate bonds. Are bonds whose interest rates are not fixed but adjust periodically according to the specified benchmark interest rates, such as the LIBOR or government bond yield. So there are several factors that may affect the floating rate, the floating rate or the floater's price. All right, floating rate bonds. There are various factors that may affect the floating rate bonds. One obvious factor is the benchmark interest rate. I've just defined a floating rate bond as bonds whose float interest rates are not fixed but adjust periodically according to a specified benchmark interest rate. So if this benchmark interest rate changes, then the floater's price is automatically going to change. If the benchmark rates rise, the coupon payments on floaters increases, making them more attractive to investors and potentially increasing their price. Conversely, if the benchmark rates fall, the coupon payments decrease, which may reduce the attractiveness of the floaters and also lower their price. So benchmark interest rate is a factor that affects the floaters price. Credit risk, number 2. The second factor is credit risk. The creditworthiness of the issuer can affect the price of floaters. If there are concerns about the issuer's ability to repay the principal or make interest payments, then investors may demand higher yields, leading to a decrease in the price of the floaters. Number 3, market sentiment. Market sentiment. This is a sentiment of the investors. Investor sentiment and the overall market conditions can influence the demand for floaters, whereby positive sentiment and favorable market conditions may increase the demand for floating rate bonds, driving up their prices. On the other hand, negative sentiment or adverse market conditions may reduce demand and then lower the prices of floaters. So market sentiment, the investor sentiment is a factor that affects the floaters price. 4, liquidity is yet another factor. The liquidity of floaters can impact their price. Where more liquid floaters are easier to buy and sell, typically commanding higher prices than less liquid ones. If a floater becomes less liquid due to changes in market conditions or due to issuer-specific factors, its price may or is likely to decline. Liquidity. 5, supply and demand dynamics. Supply and demand dynamics. Supply and demand dynamics. Changes in supply and demand for floaters in the market can affect their prices. Increased demand relative to supply can drive up prices, while excess supply can lead to lower prices, floaters prices. The normal dynamics or forces of supply and demand can affect floaters price. So these are 5 factors. Candidates were to give just 3. 1, benchmark interest rate, credit risk, market sentiment, liquidity, supply and demand dynamics. 6 marks. Part A of the question, we explained dual currency bonds and currency options bonds. These were to earn a total of 4 marks. So candidates, you can see these are easy 10 theory marks. We move on to part C. Tausi Limited issued a term bond with the face value of 1,000 shillings. The yield to maturity of the bond is 10% and it has a coupon rate of 12% per annum. The bond coupon will be paid annually. The bond term to maturity is 4 years. Required, Roman 1. The price of the bond, 3 marks. Roman 2. Macaulay duration, 2 marks. Roman 3. The modified duration, 2 marks. Number 4. The bond convexity. This is August 2023 question 1C. We are given details regarding a term bond with a face value of 1,000 shillings. So what is the price of the bond? We all know by now, candidates, that the price of the bond is the present value of the principal amount and the coupon amount. The principal amount, which is the face value, we are going to discount the face value of 1,000, and then we discount these interest payments at 12%. The bond is 10% and it has a coupon rate of 12%. The bond will be paid annually. The bond coupon will be paid annually. So that is the period, yearly. The bond term to maturity is 4 years. 4 years. So we are going to, if you are to calculate the price of this bond, the price of the bond will be equal to the present value of the par value plus the present value of coupon payments. And this one is a lump sum. The par value is paid once. It's a lump sum. The coupon payments, these are annuities. So we are going to use different present value factors. This will be present value interest factor Rn. We multiply with the 1,000, the face value, plus present value annuity factor Rn times the annuity of 120. Is it 120? Yes, 120. How did I get 120? I took the coupon rate of 12% times 1,000. 12% times 1,000 is equal to 120. This will be equal to, this factor will be 1,000 times 1 over 1 plus r, 1 plus r, 1 plus r, plus the factor here is 1 minus 1 over 1 plus r raised to n over r. That will give us the factor times 120. You understand? So the R will be the 10%, the yield to maturity, the 10%. So this will be equal to 1,000 times 1 over 1.1 raised to, this will be raised to n raised to 4. That is the period. From the question we read, the bond term to maturity is 4 years. So this you are going to add here, 1 minus 1 over 1.1 raised to 4 raised to 4 times 120. So this is going to be the price of the bond. I'll take my machine. So the rest is the work of the machine. We discount this, we discount that, then we add. And this is over R here. This should be 0.1. 10% into decimal, 0.1. So the rest is the work of the machine. So that is the value of the bond. The price of the bond is 1,000 shillings and 63. 1,000 shillings, 1,063, 397 cents. This is Roman. 1, Roman 1, C Roman 1, C Roman 2, you are to calculate the Macaulay duration. Now, candidates, Macaulay duration is a concept that is used in fixed income investing to measure the average time it takes to receive all the cash flows, both the principal and the coupon payments from a bond, which is weighted by their present value. In simple terms, it tells you how long you should expect to hold the bond on average to get your money back from to get the money that you invested back plus the interest. And Macaulay is named after Frederick Macaulay, who was an economist who introduced the concept around 1938. So by that definition, candidates, you can tell the formula. I've said that Macaulay duration is a measure that helps us determine the average time it takes to receive all the cash flows from a bond. And the cash flows include the principal and the coupon payments. And we use a weighted present value, which means you are going to have the present values, then we compute their weights, then we'll multiply the weights with the period to determine the Macaulay duration. So that is the formula. We're going to have here period, and we know there are 4 periods. These are 4 years. Period is 1, 2, 3. The next column is the cash flows. We know the cash flows include the principal of 1,000, which is the par value of the bond, and the coupon payments of 120 shillings per annum. That is the cash flows. We'll have another column for the present values, PV. So we'll have the periods. Let me put them down. 1, 2, 3, 4. The cash flows at the end of year 1 is 120, 120, 120. The bond term to maturity is 4 years. All right, it is 4 years, which means in the 4th year we are going to have the 120 plus the principal, the 1,000 plus the principal, which will be equal to 1120. That will be the cash flow at the end of year 4. Do you understand? So we're going to have the present values of these cash flows under that column. That is the present value. Then we'll use these present values to calculate the weights. We're going to have a column for the weights. Then lastly, we will multiply the weights. We will multiply the period times weight. These are the periods. So that is the formula, candidates. That is the formula for calculating Macaulay duration. So let's work out the present values. This is 120 shillings per annum. We are going to discount this 20 as a lump sum. At the end of year 1, we discount the 120 at 10%. So you're going to have 120 divide, we open a bracket, 1.1, close the bracket, raised to 1. So when you discount this 120, I'm getting here 109, 109,090, 109.090. Second year is 99.174. Next, raised to 3 years, 90.157. Next, I have the 1120, 764.9. This is 975. 764.975. So you get the total here to allow us have the weights. So I'm going to add this present values, 106, 3.40. That is total present values. Then we get the weights. How do we calculate the weights? We're going to take at each period, we divide by the total, then we'll have the weights right over there. So firstly, year 1, we have 109. This 109.090 divide by 10, 1063.4. 0.103. Next, I'll take 99.174, 0.093. Next is 90.57, 157 divided by the total, 0.085. Then lastly, I have, this is 0.719. Yes. So this should give us 1.0. Those are the weights. So the last column will take the weights times the period. The first one is 1 period. The first period we take 1 times 0.103 is equal to 0.103. Next, we are going to multiply 2 by 0.093, 0.186. Next, we'll have 0.085 times 3, 0.255. Then lastly, I'll take 0.719. This gives me 2.876. After that, we'll add this product of period and weight to get the Macaulay duration. So I'm going to add, so the answer here is 3.42. 3.42 is the answer. 3.42 is the answer, is the Macaulay duration, 3.42. That is the answer. So how many marks? These are just 2 marks. Can you imagine? Just 2 marks because it is simple. This is simple, 2 marks. Remember I said maculae duration is a concept that is used in fixed income investing to measure the average time it takes to receive all the cash flows, both the principal and the coupon payments from a bond. So it is going to take 3.42 years. So candidates, that is Roman 2. Then Roman 3, modified duration. We want to calculate the modified duration. Modified duration. Now here, what is being modified? Here, candidates, is a refinement or a more precise measurement. The modified duration is a more precise measurement of the bond's price sensitivity to changes in interest rates compared to the maculae duration. It is this maculae duration that is being modified here, what we are calling modified duration. It addresses some of the limitations of the maculae duration by incorporating the bond's current yield to maturity. That is to say that modified duration is determined by dividing the maculae duration to modify this maculae duration. We're going to divide by the maculae duration by incorporating the bond's current yield to maturity, which is equal to 1 plus the yield, then we divide by K, where K is the number of periods per year. In our case, the periods are 4. And the yield is the yield to maturity of the bond. The yield to maturity of the bond, we read from the question, the yield to maturity of the bond is 10%. And therefore, the modified duration will be equal to the 3.42, which we calculated in Roman 1, 3.42, we divide by 1 plus the yield. The yield is 10%, which is 0.1, divide by 4. K is the number of periods. The number of periods. So this is going to give us the modified duration. Modified duration, which is equal to 3.34. The modified duration there is 3.34. 3.34. Now, part 4 of the question is about, this is Roman 2, Roman 3, then Roman 4. We have the bond convexity. Now, a bond convexity is a measure of the sensitivity of a bond's duration to changes in interest rates. And bond convexity provides additional insight into how a bond's price will change in response to interest rate movements beyond what is captured by the modified duration. So this is a more refined measure compared to the modified duration, which is a modification of the maculae duration. So let's compute the bond convexity of this bond. We are given the period. This is how to compute. Going to have periods on the first column. Then we'll have the weights, which we have already calculated. The weights we calculated here, we'll use these weights. Then we'll have convexity here. Convexity. We'll calculate the convexity, the last column. And convexity will be calculated at, first of all, at each and every period. Then we'll sum the convexities to get the bond convexity. And here is the formula for convexity. We're going to take the period into 1 plus period times weight. So we'll have period into 1 plus a period times weight. We divide by 1 plus yield to maturity squared. That is the formula for convexity. We're going to first of all have period 1 here. The weight for period 1 is 0.103. 0.103. So convexity period 1 will be the period which is 1 into 1 plus period 1 times the weight 0.103. 0.103 we divide by 1 plus the yield to maturity. The yield to maturity is 10%, so this will be 0.1 squared. For period 2, let me first of all calculate the answer here. I'm going to have 1 times 2 times 0.103. So this is simply 0.17. So convexity at period 1 is 0.17. Period 2, the weight period 2 is 0.093. 0.093. The period here is 2 into period 2 into 1, we have 1 plus period 2 times weight 0.093, divide all that by 1.1 squared. So here I have 0.46. 0.46, that is period 2. Period 3, weight 0.085. 0.085. Convexity is 3 into 1 plus 3 times 0.085, divide by 1.1 squared. It's equal to 0.84. 0.84. Then the last period, the weight 0.719. 0.719. Period is 4 into 1 plus 4, 0.719, we divide by 1.1 squared. 1.1 squared. So 1 plus 4, 5 times 4, 20 squared. 11.88 is convexity fourth. This is the fourth period. Convexity, the fourth period. So having calculated convexities at each and every period, we then sum these convexities to get the total bond convexity. So I'm going to add 13.35. 13.35 candidates is the bond convexity. That is the interpretation and the answer, 13.35. We've answered the bond convexity 3 marks. 3 marks, 1, 2, 3. These are 1, 2, 3, 4, 5, 6. Half each to earn 3 marks. These are 3 marks. That is Roman 4. Roman 3 is just 2 marks. 1, 2, 2 marks. Roman 2, maculae duration. Maculae duration is 2 marks. Maculae duration 2 marks. Then the price of the bond, again 3 marks. 1, 2, 3 marks. The price is there, 3 marks. 3 marks. And that effectively brings this lesson to an end, where we have answered question number 1 from the August 2023 sitting. The subject is fixed income investment analysis. In our next lesson, we're going to answer question number 2. I urge you to attempt it before joining our next session. Thank you. God bless you. Bye-bye.